Hi guys! Welcome to another edition of our Stock Smarts Basics, where we answer a lot of your basic questions when it comes to finance, when it comes to investing, and everything else in between. For this video session, I want to talk about the difference between investing directly in the stock market versus investing in mutual funds as a whole, because there's a lot of comparison and a lot of people asking, why should I invest in mutual funds when I can invest directly in the stock market, or why should I invest in the stock market when there's a passive way to invest? And mutual funds have done also a handsomely good job in terms of providing earnings that are better than inflation, better than bank products as well. So between the two, personally, I have investments directly in the stock market, and I also have investments in managed funds. When I say managed funds, it could be UITFs, it could also be mutual funds, and it could be VULs as well. All of those three, I have them, because you have to understand this: mutual funds, UITFs, VULs, and the stock market in general, they're not in competition. They're not your opponents. They're not fighting each other. They're supposed to be there to help you. They're supposed to be assets that will generate income for you. They're supposed to be there to help you reach your goals of financial freedom. So what's the difference between the two, and why is there such a shroud of I don't know, there's such an angst for people who are hardcore stocks. They don't like to invest in mutual funds, and there's a group of people also who like funds and they don't like to invest in the stock market in general. But for me, get both. It doesn't matter. The only difference between the two is this: number one, for funds, you have fund managers who will do the investing for you. Because you have fund managers who will do the investing for you, of course, there will be fees. Fees which some people, they don't like, because for some, they don't like paying fees when the market is down. Why should I pay someone if they're not doing a good job in their work? That's one perspective to do it. And of course, if you have fund managers who are managing other people's funds, other people's money, they might be a bit conservative as well. So for some people who are relatively aggressive, they find investing in funds a bit in the average side as well. But let me give you a flip side to all of it. If you don't want to watch your investments, you don't want to study, because when you invest in the stock market directly, it must be you who must select when to buy the stock, when to sell the stock, how much stocks should I buy, how should I proportion it, when's the best time to time it, how could I actually find a good way to be able to create a balance in between. If you don't want to go through all of that, you don't want to study fundamentals, you don't want to study technicals, you don't want to study portfolio management, stock allocation, stock management, probably investing in mutual funds is a good way for you to go. And because of that, you're leveraging on the strengths and abilities of the fund managers, and it's also rightful for you to pay them as well. Second thing about that is this: if you're not really good in stock trading, you're not good in stock investing, and you might underperform, sometimes getting the average is just relatively okay. Getting the average is better than losing money. I've seen a lot of people who bought wrong stocks. Some people bought stocks that have been down for 2, 3, 4 years already, where investing in mutual funds would have done a better job for them. So why am I saying this? You have to find what fits you the most. There's no such thing as the best investment. There's no such thing as an investment that fits all. But you have to find a mix of both. That's why I'm telling you to open both of them, so that you can see where your strengths are. If you're doing better in the stock market, so it makes sense to open and put more money in stocks later on. If you're doing better in managed funds or mutual funds, then it might be better for you to put more money there later on as well. But for those who want to be passive and want to invest in mutual funds and want to be relatively passive, I would suggest this. Try to open in what you call an exchange traded fund or an index fund, something that would track the index as a whole. Because I always say this in my seminars, that index funds, they go down, but when they go down, they always go higher than where they were before, and that's what's amazing about it. Some stocks in the stock market, pwede silang malugi, they can close down. Look at the Kodaks, the Uniwides, look at even Kalata, which will be delisted. But if you're investing in an index fund, there's no way for the index to close down. Why? Because it's recalibrated every 6 months. So if you want to be passive, you want something that will grow over the long term, and you want something that has an historical track record, get an index fund, because it's relatively passive. It's similar to its concept is still a mutual fund, but it gives you exposure to the stock market already. So that's how you can actually spin it. Another way to do it is you go by the example that I gave you in the previous video. If you want to be passive, just buy stocks that give you good dividends and hold on to it. You have to remember this, you don't lose money in the stock market if you don't sell at a loss. So as long as the stock is giving you dividends, you're supposed to be okay as well. But if you're looking for growth and you want to study it well, I really believe the stock market can give you the possibility to gain money, gain growth, which is above and beyond what you can get on an average fund as well. So find what works for you. Another thing about the stock market is this: you only pay money to brokers every time you buy, and you only pay every time you sell. There's no more additional charges every time you transact. For how long you hold the stock. You can hold the stock for 10 years, but you don't pay anything anymore. And that's what a lot of people like about it, because the charges are relatively cheap. For funds though, on a monthly basis, you're paid. You have to pay a fund management fee. So there, costs for funds are higher than investing in the stock market. But for funds, you're leveraging on the strengths of other fund managers who have probably better expertise than most people when it comes to investing. However, if you gain the skills already, it might be good to invest directly, and especially if your timeline is longer, investing in the stock market is very, very, very good as well. So I hope that helps you. It's just a quick differentiation on the differences between managed funds versus investing directly in the stock market. Again, there's no right or wrong. You can always find something that will fit you, but it will never work if you don't try. I always say this in every video that I make. It's time for you to actually start. It's time for you to actually start trading, because if you don't actually do it, then you won't experience it. If you don't experience it, you won't gain the conviction, you won't gain the experience, and you won't gain also the knowledge that will help you later on to make critical decisions when it comes to your investment. And I hope this video helps you. We're gonna make more and more videos like this. The goal of this really is to build more and more Filipinos investing in the stock market and in equity funds. And that's what I always say. I hope this helps you trade well, trade strong, trade smart. This is Marvin Germo from Kuala Lumpur, Malaysia. God bless you.